AI, it was the word on everyone's mouth for some time now. AI stocks were jumping higher in investor portfolios, people pouring in millions in the tech space. Now, global AI and tech stocks are experiencing a sharp decline, shaking investor confidence and rattling markets worldwide. Several interrelated factors explain this downturn, and this despite the strong promise AI held earlier in 2025. First, the US stock market sell-off was triggered by warnings from major Wall Street banks like Morgan Stanley and Goldman Sachs, which cautioned investors that equity valuations are stretched and a market correction could be on the horizon. The surging valuations of AI and tech giants had created a bubble-like environment, with stocks like Nvidia, Tesla, Amazon, and Plantair losing significant ground in recent days. Second, the rising concerns over broader economic outlook are weighing heavily on tech stocks. New data suggests signs of weakening labor market and slowing economic growth. Investors worry that persistent inflation combined with the Federal Reserve interest rate hikes is suppressing corporate earnings growth. Even though AI companies continue to grow revenue, many reports show that their earnings, while good, are not exceeding already high expectations enough to justify the lofty stock prices. Third, geopolitical tensions and ongoing US-China trade frictions add uncertainty. Tariffs and trade barriers have increased costs for many tech companies relying on global supply chains, pushing investors towards caution. Say Nvidia, for example. China has shut Nvidia out of its markets, which is a huge hit for the most valuable company in the world. Its CEO has said last month, and I quote from his statement, "We want the world to be built on American tech stack." Absolutely, that's the case, but we also need to be in China to win their developers. A policy that causes America to lose half of the world's AI developers is not beneficial in long term. Additionally, the US government shutdown has intensified market uncertainty by limiting the availability of official economic data. Traders are increasingly relying on private sector reports, which so far signal some caution and risk aversion. The tech-heavy Nasdaq and AI-related momentum stocks are particularly vulnerable given their high valuations and sensitivity to shifts in investor sentiment and economic conditions. This has led to profit-taking, with many investors locking in gains after an extraordinary AI boom. Lastly, the broader risk of sentiment has pushed capital into safer investments like US Treasury bonds and gold, causing bond yields to rise and adding pressure on growth stocks, including tech. In short, the recent fall in global AI and tech stocks is a result of stretched valuations, economic growth concerns, inflation, geopolitical risks, and rising uncertainty amid a complex macroeconomic backdrop. Investors are recalibrating expectations for profit and growth, ushering in a more cautious environment for technology equities.
If you like this video, then like, share and subscribe to ET Now.